Welcome to the fourth lesson of Chapter 6, Decoding Margin in Forex Trading. Today, we're going on an enlightening journey into the world of margins. You'll come to understand why margin is the backbone of Forex trading, allowing traders to hold significant positions, far beyond their actual capital. You'll grasp how it functions as a form of financial leverage, amplifying the potential for both profits and losses. We'll also delve into the nitty-gritty of how margin works as a performance bond, a good faith deposit, and how it contrasts with the full position size. We'll illustrate these concepts with practical examples, making them easy to comprehend and apply in real-world trading scenarios. Lastly, we'll explore how understanding margin can profoundly influence your trading strategies and outcomes. So get ready. Prepare to delve into the intricacies of margin as we decode its concept and application in Forex trading. Margin is fundamental to Forex trading. This statement couldn't be more accurate. Margin is the cornerstone of the Forex trading landscape, acting as a key player in a trader's financial game plan. It's the financial cushion that allows traders to step into the world of Forex with confidence, providing them the ability to hold significant positions without needing to cover the full trade value. Think of margin as a kind of financial leverage. It's like having a power booster in a video game, amplifying your abilities and letting you reach new heights. In the case of Forex trading, margin amplifies a trader's ability to make large trades with a relatively small capital amount. This means that even with a limited budget, you can still play in the big leagues, taking on substantial positions and potentially reaping substantial rewards. But here's the thing, margin isn't just about boosting your trading power, it's also about managing risk. By using margin, you're essentially borrowing funds to open larger positions, meaning you're also taking on a larger risk. If the market doesn't swing in your favor, you're liable for the losses, which could exceed your initial investment. So, while margin can be a powerful tool in the right hands, it's important to use it wisely. Understanding how margin works can help you make better trading decisions and manage your risk effectively. Thus, margin can significantly increase your trading power. But remember, with great power comes great responsibility. Use margin wisely, and it can be a valuable ally in your Forex trading journey. Margin works as a performance bond or collateral. Think of it as a security deposit you provide to your landlord before moving into a new apartment. It's a safety measure, ensuring you have enough funds to cover your trade positions. Imagine you're a trader. You've set your sights on a promising currency pair, but the full value of the trade is a hefty sum. You don't need to have the full amount. Instead, you provide a fraction of the total value, known as the margin. This margin acts as collateral, holding your position open in the market. Now let's clear up a common misconception. Margin is not a cost or fee you pay to your broker. It doesn't disappear into your broker's pocket. Instead, it remains in your trading account, earmarked to maintain your open positions. If your trades move in your favor, great. Your profit is yours to keep. But if the market turns against you, the margin serves as a buffer, absorbing the losses up to a point. If the losses exceed the margin, you'll receive a margin call from your broker, urging you to deposit more funds or close your positions. In essence, the margin is your financial safety net, catching you when your trades fall. It ensures you have enough funds to support your trading positions, mitigating the risk of a catastrophic loss. So, margin works as a safety net for your open trading positions. Let's see margin in action. It's time to dive into the practical side of things to truly understand how margin works. Imagine you're a Forex trader, and you've taken a fancy to the USD-JPY currency pair. You decide you want to buy $100,000 worth of this pair, but hold on, you don't actually have $100,000 to spare, do you? This is where margin comes into play. With margin, you don't need to have the full amount. Your broker might only require a 3% margin to open this position. That means you'd only need $3,000 to control $100,000 worth of USD-JPY. In essence, you've just amplified your purchasing power by over 30 times, all thanks to margin. But remember, with great power comes great responsibility. While the potential for profit is amplified, so too is the potential for loss. Now let's consider another scenario. You have your eye on the EUR-USD pair this time, and you want to buy $50,000 worth. Your broker requires a 2% margin for this pair, so you'd only need to have $1,000 in your account to open this position. In this case, you've leveraged your capital by 50 times. Again, this amplification works both ways. The potential gains could be significant, but if the market moves against you, the losses could be just as substantial. These examples illustrate how margin can facilitate large trades with minimal capital. It's like a powerful tool in Forex trading, allowing you to operate on a much larger scale than your actual financial capacity. But remember, it's a double-edged sword. While margin can magnify your profits, it can also amplify your losses. So tread carefully and trade wisely. Margin also acts as a good faith deposit. It's like a poker game where you put down your chips, not just to play, but to show you're serious about the game. In Forex trading, the margin is your poker chip. It's a demonstration to the broker of your commitment to the trade. You see, when you open a position, you're essentially making a promise that you are prepared and capable of handling potential losses. Your margin is a testament to this promise. This doesn't mean you'll lose the margin amount. It simply acts as collateral, a buffer of sorts to ensure the broker that you can cover your trading obligations. But remember, while margin opens up opportunities, it also presents risks. It's a double-edged sword, and a trader must handle it with respect and understanding. So when you put down your margin, you're not just signaling your readiness to trade, but also your understanding of the financial implications that come with it. Margin, therefore, serves as a commitment to the broker. There's a difference between the full value of a position and the margin required. This difference is as significant as it is misunderstood. Let's demystify it. Picture a pie sliced into 10 equal pieces. The entire pie represents the full value of a trading position, the total amount you're investing in a currency pair. But if you're using margin, you don't need to bring the whole pie to the table. You only need to bring one slice, or maybe even just a sliver. That slice, that fraction of the pie, is your margin. Margin trading is like a ticket to a high-stakes game where you don't have to put up all the cash. The margin is your ticket in, and it's a fraction of the total value of the position you're taking. It's your skin in the game, your commitment to the broker that you can handle potential losses. But remember, just because you're only putting down a fraction of the total value doesn't mean you're only liable for that fraction. If the market moves against you, you're still on the hook for the full value of the position, which can lead to losses far exceeding your original margin. This is the reality of margin trading. It amplifies your potential profits, but it also amplifies your potential losses. It's a powerful tool, but like any tool, it must be used wisely. Remember, the margin is just a fraction of the full position size. Understanding margin is crucial for traders. With those words, let's delve into the significance of margin in Forex trading. Now picture this. You're a trader, and margin is your key to unlocking larger trading possibilities. It's the financial leverage that amplifies your trading prowess, enabling you to control sizable positions with relatively small capital, like David facing Goliath. But here's the catch. With great power comes great responsibility. The same margin that gives you the ability to trade larger also exposes you to higher risk. It's a double-edged sword that can cut both ways, so while you gain the potential to make large profits, you also risk substantial losses. That's why understanding margin is akin to understanding the level of risk you're willing to accept. Think of margin as a sort of scale. On one side, the power to trade larger positions, and on the other, the risk of potential losses. Balancing this scale is the art and science of Forex trading. The more you understand margin, the better you can manage this balance. Margin isn't just about trading bigger, it's about trading smarter. It's about knowing your risk tolerance, managing your trades wisely, and always being prepared for the potential ups and downs of the market. Margin, thus, influences your trading capacity and risk exposure. It's a tool that, when wielded wisely, can help you navigate the exciting yet unpredictable world of Forex trading. So, dear traders, understand your margin, control your risk, and trade with confidence. Scene script: margin can significantly impact your trading strategy. Let's delve into how this happens. Picture margin as a double-edged sword. On one hand, it offers you the power to control large trading positions with a small capital outlay, amplifying your potential profits. Imagine you have $1,000 in your account and a trade opportunity comes up. With a margin requirement of 1%, you hold the power to control a position up to $100,000. If the market swings in your favor, your profits are calculated on the full $100,000, not just your initial $1,000. It sounds like magic, doesn't it? But as with all things powerful, it comes with a catch. The same leverage that magnifies your profits can also amplify your losses. If the market turns against you, Your losses too are calculated on the $100,000 and not just your initial 1,000. This could potentially lead to losses that exceed your account balance. Therefore, understanding margin and leveraging it appropriately is crucial to crafting a robust trading strategy. It's not just about the potential for higher profits, it's also about managing the risk of larger losses. So carefully consider the effect of margin on your trading strategy. It can be a powerful tool, but only when wielded with caution and understanding. Remember, in the world of Forex trading, knowledge is your true power. Let's talk about the margin requirement. It's a critical concept when leveraging your Forex trading. See, margin requirement is the percentage of the notional value or the total value of the trade that you need to have in your trading account as margin. It's like a safety net, ensuring that you have enough funds to cover potential losses from your open positions. Now, this requirement varies from broker to broker and can depend on the specific currency pair you're trading. Some brokers might require a 2% margin, while others might set it at 10%. It's crucial to understand that the higher the margin requirement, the less leverage you have. Remember, margin doesn't eliminate risk, it only reduces it. And while leverage can amplify your profits, it can equally amplify your losses. That's why understanding your margin requirement is key to managing your risk and making informed trading decisions. Margin requirements ensure you have sufficient funds to support your trade. To better understand, let's look at some examples of margin requirements. Imagine you're a trader interested in the USD-JPY currency pair. You want to buy $100,000 worth of this pair, but your broker has set a margin requirement of 3%. This means, instead of putting down the full $100,000, you only need to deposit $3,000 to open this position. Let's take another example. Suppose you want to trade the EUR-USD pair, valued at $50,000, with a margin requirement of 2%. In this case, you'd only need to deposit $1,000 to control the entire position. These scenarios demonstrate how margin requirements allow you to control large positions with a relatively small amount of capital. However, remember that while this can amplify potential profits, it also amplifies potential losses. These examples should help you grasp the application of margin requirements. To wrap it up, margin is a powerful trading mechanism. It's the financial lever that swings the door wide open to significant market positions, even when your capital is limited. But remember, with great power comes great responsibility. Margin is not merely a tool for amplifying your trading capabilities, it's a testament of your commitment to your broker and a reflection of your ability to handle potential losses. It's a good faith deposit, a performance bond that signals your readiness to play the high-stakes game of Forex trading. However, the very feature that makes margin a potent ally also makes it a potential risk. The proportional increase in potential losses is a reality that every trader must face. As we've journeyed through the world of margin, we hope you've gained a comprehensive understanding of its role and significance in Forex trading. Thank you for joining today's lesson. We encourage you to move on to the next lesson, grasping the concept of used margin. Until then, happy trading.